investment outlook. All right, welcome to our August investment outlook. Good morning to everybody joining us in Europe, and good afternoon to everybody listening in from Asia for our August investment outlook live stream. Great to have you with us again. Our theme this month is crypto's summer surge. The crypto market cycle has further room to go and to grow. It has been a little bit of a stable coin summer driven by a lot of action in the market. And together with my colleague Katalin Tischhauser, Signum's head of investment research, I will unpack the biggest macro and crypto market drivers that have been shaping August so far. As always, all content and opinions in the live stream do not constitute any investment advice. And with that, let's jump straight into our topic number one. And of course, we'll start with the macro, just like usual. And when we look into the macro environment, we would rather say unpopular opinion, and that is the state of the US rate cuts, because we're of the opinion that they might not come anytime soon. The US administration continues to push for a September rate cut despite poor economic data and sticky inflation. Why might such a move backfire in the current environment, Katalin?
Yes, thank you. And I'm not even sure that it's an unpopular opinion. It's definitely an uncommon opinion out there, just looking at the rate cut probabilities, which are still very high since the jobs data that disappointed to the downside. The probability doubled from 40 to 80 and then basically went to 100% for a while. And since the very negative surprise on inflation is now a little bit less, but still super high. And the question I ask is, why would there be a rate cut? And there's two questions there. Is there actually a need? And will it achieve what people think it will achieve? And on both of those counts, I think potentially differently than the market consensus appears to think. The idea is that rate cuts are needed to stimulate the economy. Now, whether they're needed, I think is not that clear. There's actually, despite the jobs data, the economic indications of the underlying strengths of the economy are not that dire. Now, obviously, the Fed has to be ahead of the curve, not behind the curve. But what we could see just now, against the backdrop of actually not bad data, decent earnings, GDP growth, it's hard to tell where GDP growth is because the tariffs brought imports forward and then used up the inventory. So we have these very statistically aberrant numbers of minus 0.5% in Q1, then +3 in Q2. But it's roughly about chugging along at 1.2% or maybe even higher. But more importantly, now that the tariff stuff is getting sorted out, a lot of the pose of companies kind of being on hold, not investing, not knowing where to go, a lot of delayed investment could actually happen now. So I think that the need is not at all clear in terms of the underlying growth trends of the economy, and the inflation trends are very negative. It's going up much more than people thought it would. How far will it go? We will have to wait and see. And Powell has definitely said he wanted to wait and see. But what is even more important to my mind is that if they did cut, would that stimulate the economy? Because actually, what it would achieve maybe is that money market funds, if the rates are kind of too low and everything else looks okay for risk assets, then maybe there's a shift into risk assets. But the underlying economy, it hinges much more on bond yields. Business loans, mortgages, and so on, they're at the long end, not at the money market end. So the question is, what will bond yields do? And in the face of a lot of inflation already, and clearly the trajectory pointing upwards, I think rate cuts could be counterproductive in that bond yields could rise. And bond yields are already fairly shaky. The bond market has been very upset by the failure of Doge, the Moody's downgrade, and just the kind of spiraling US debt and budget deficit and so on. So everything is in a much worse shape, let's say, than a year ago when the Fed started cutting rates. And even then, the actual result was steep sell-off in bonds, rise in inflation, and growth contracting, slowing down. Now the backdrop is worse, because then inflation prior to that was falling. Now it's already actually accelerating. upwards, and the bond market is much more shaky. So I think it's quite likely that if the Fed did cut, it would have not a stimulative effect, but a contractionary effect, and plus be inflationary. So the other question that people ask is, of course, aside from the macroeconomic fundamentals, where I think it wouldn't make sense if they did cut, it probably wouldn't do what people think it would do. It would probably be a negative. But the other question is, why is there so much pressure from the administration, as clearly there is, and will Powell yield to that pressure, right? So even though it doesn't really make sense, it probably wouldn't do any good, but because of the political pressure, including, threatening him with, I don't know, impeachment because of the renovation of the building or whatever, and just the constant pressure, would Powell yield? Now, I see no signs that Powell would be yielding. He's going to speak on Friday. Maybe we'll hear something different, but so far Powell has been a steady pair of hands, and I have seen not an iota of a sign that he would be shifting. And also, even though there are more and more, there's another Trump appointee among the Fed governors now after the sudden resignation, they're still in minority. So it's, people say that this will shift the balance, but it's not shifting the balance, as in shifting to majority. So I think it's unlikely. I'm not even sure why this pressure exists from the administration, to be honest, because obviously economically it probably wouldn't make sense, and it's not even necessary. There's a lot of liquidity around globally, as well as in the US. There's many ways to provide liquidity that can be much more effective under the current circumstances than an actual rate cut. So it's likely to be, maybe that they want to refinance a lot at the short end, in terms of government debt that's coming due for refinancing, or maybe as Powell's term is going to expire next May, and he's obviously not going to be renominated. That's clear now. That maybe he's lined up to be the scapegoat for any potential economic problems that lie ahead. So it's not clear, but I think net, I think it's unlikely. I wouldn't even think it would be good news if there were a September rate cut. Maybe later on the economic picture changes, inflation eventually slows down. Tariffs are kind of a one-off hit in many ways. We just don't know yet how far it's going to go, because until now it's being swallowed to a great extent by the importers. But as far as the markets are concerned, I think the markets are in a good shape anyway. Obviously, there could be short-term disappointment, but liquidity is plentiful. And if you just think about how many rate cut disappointments the market has swallowed in the last 2 years, throughout like a big part of last year, and then also this year it was going to be a June cut, a July cut, and then the market just kind of resigns itself to zero probability, and the rate cut doesn't happen, and we have seen more all-time highs in the last 2 years than I've had hot dinner. So that's clearly not been standing in the way of this current cycle continuing further, which I think it will.
Yeah, and you made some super interesting points with respect to also like why this administration is applying the pressure, right? If you think about it, like the administration is still in place for 3 more years, right? And we have midterms in a year and a half coming up. And this might all just backfire. A too early cut might lead again to a bit higher inflation, so it will have an impact on the voters' pockets, what to buy and how to buy it. And even if you're able to refinance that now on the short term for lower rates, in a year from today, you might have to refinance that if you refinance it at the short and for higher rates. So that political pressure that is coming from the White House and from the Treasury, also where individuals are, it's very interesting to see. And
I agree with you, and I think maybe the pressure on the budget is just so great that it's kind of a priority,
right?
And especially after the disappointment on cutting expenses and the big beautiful bill bringing just more of that, and the debt ceiling raised again, and what we mentioned, Moody's downgrade, and so the market reacting very negatively. Maybe that is just a priority to firefight.
Yeah. Okay. Yeah. Super interesting. And the budget, on the budget side, that ties us into our second topic right away, and that's the tariff situation, right? Something that has, of course, been part of the macro story for the last 4 months, ever since April. And it seems like all of this has slowed down a bit, right? And our second topic is tariffs. Are they divorced from economic policy and market reactions? It seems that Washington's tariff policy is increasingly detached from its economic goals and more tied to geopolitical aims, right? To what extent do markets start shying away from this tariff story? What it seems like they do.
Yeah, I mean, it's, the tariff story is I think it's now increasingly in the rearview mirror, and that's a good thing. And even for a while now, the markets have traded them as what they call the taco, that, Trump always, but that basically it won't happen. All these things that are being threatened will not actually happen, so just ignore. I mean, the geopolitical aims were obviously not achieved. Not in terms of, threatening China, who had the stronger hand all along, because of the US's extreme dependence. Every time the US threatens China with more tariffs, like they did again recently through, just countries that buy Russian oil will get 100% or 500% tariffs. China immediately cuts the rare earth exports, and then the tariff goes away. So, but also, this greater cohesion amongst the BRICS, like the BRICS used to be a fairly vague, loose, not very focused grouping, if you could even call it that. And what drove them close together and what created the cohesion is the US putting economic pressure on various countries around the world. So they had a compelling incentive to develop alternative trading systems, alternative payment and settlement systems, move away from the dollar, and so on. So it's exactly the US using its economic power to pressurize countries, what is creating a greater and greater BRICS cohesion. So when there are more tariffs threatened with these geopolitical aims, and for example, now India was seen as possibly the weak link, and so the tariffs went to India, but there's so many carve-outs that it probably nothing, but it didn't achieve, it achieved the opposite goal. The BRICS are pulling even closer together. Certainly none of them agreed to cut trade with Russia or any of that, but their cooperation is accelerating. So this has been not just ineffective, but I would say counterproductive. But then the US reverted to the secondary goal, and that ties back to our previous conversation, which is raising revenues. So tariffs do that. Tariffs are currently the highest maybe ever or something like that in the US. And definitely, one, maybe the clearest example that revenue raising is such a critical primary goal now for tariffs is what happened to Switzerland, right? There's 39% tariffs for no reason whatsoever, and no one understands, and no actual explanations given. And Trump gave the explanation. He said Switzerland's a rich country. I take the money where I find it. So I think that, and that is definitely helping. For example, I mean, there is, it's helping the budget. How much is it helping? It's really relative to the US debt that's growing incredibly fast. It's a drop in the ocean, frankly, but it is helping right now. The optics are certainly good. The S&P confirmed the AA+ rating just yesterday or something like that the other day. And acknowledging specifically that there's revenues from the tariffs, and that's helping, and that's a good thing. So and now I guess the next move is there any reindustrialization? Despite it being the number one stated goal, I think it was at best the number 3 goal of this whole tariffs project. But it is, of course, it is one of the desired goals. It's just not been the focus. And now maybe that's coming a little bit more into play now. The trade agreement, not even agreements, just frameworks with the EU, Japan, and so on, that compel these countries or regions to invest in the US. I think that's fairly flaky, because the agreements are very loose, and the EU already said, look, it's private companies that have to invest. We can't make that happen. We can just advocate for it and suggest that companies do it, but we cannot guarantee that this will happen. And it's similar in Japan. So I think that is not very powerful, even though it's part of this framework. But what is maybe working better is US companies. So saying, you can get relief from whatever tariffs if you invest in the domestic market. Apple, for example, straight away invested $100 million. And so there could be reindustrialization to a degree coming. And now that there is much more clarity, not full clarity, but quite a lot, I think we could see some of that. And the China situation looks like it's good news that it's a managed divorce. It's a gradual, slow. They just keep postponing, which is the best outcome. The US's extreme dependence on China had to be cut, and China understood that for a long time. Both sides understand that this relationship has to be unwound. But if it's done, of course, in a very abrupt, dramatic way, then the consequences are very negative. If it's done in a managed, gradual way, then that's a best case scenario, which is kind of what we have on this one.
Yeah. Okay. Yeah. And markets were able to digest all of this over the last couple of months. And
and markets like it. Markets like it, and I think they like it for the right reasons. I think there was this big shock, and ever since then, it's actually working itself out in a reasonable way.
Right, exactly. Yeah. Right, yeah. Let's switch gears a little bit and focus on the crypto side of things. And contrary to previous live streams, we'll start with Ethereum this time, just because we have to. So it has been Ethereum summer, it has been stablecoin summer, on-chain activities. Wall Street's finest have moved further into this space together with the largest investment managers of this world. It has been super busy. Treasury companies, stablecoin legislations, ETF flow momentum, and Ethereum ETFs. So over 5 billion of inflows just in July, and a record daily inflow of about 1 billion just in August. How much of Ethereum's or Ether's rally is being driven by certain fundamentals, such as the Pectra upgrade, stablecoin legislation, versus like the short-term trading of ETF, the ETF momentum, and short-term traders?
Yeah, I mean, I think it's been so powerful and so steep, basically 3x, because it's both. The fundamentals really were there, Ethereum sensing their crisis, rejigging their development roadmap, refocusing on driving revenue to the layer one, that kind of philosophical change that the market acknowledged. The revenues after Pectra increased, the fee income and revenues to Ethereum increased substantially and clearly, and it's been sticky ever since, so it's kind of real. And there's also the very powerful narrative, which was always true, that Ethereum having the largest market share across use cases, and the greatest blue chip security, that it's quite likely that TradFi will favor it, and so on. These kinds of narratives, this was always true. But suddenly the narrative started focusing on it, having ignored it for a long time. And the stablecoin summer, as you mentioned, or the focus of stablecoins, Ethereum really seen as, we'll see how things will actually work out, but definitely currently seen as the primary beneficiary of this use case that's really powering ahead currently. And then it's also supported by certain opinion leaders, and Ethereum also found its let's say Michael Saylor or its strong advocate in Tom Lee, someone, a respected opinion leader who's really advocating for this narrative. So all of this had an effect, but it's also to some extent just flows, right? Because the Ethereum ETFs, I mean, we certainly always expected that the inflows will come with a delay, that TradFi, these new types of investors were just digesting what Bitcoin even was, and it just came too soon and too suddenly for them to focus on it, understand it, get the approval, so that there was going to be a delay. And these kind of dovetailed the fundamental changes, and then these approvals, which were going to take a little longer, and they're kind of happening at the same time. And then the big fuel, the Ethereum treasury companies. And again, Tom Lee is, that's why he's sort of a little bit like, like Michael Saylor for Bitcoin, but they took off so fast. It took, I think, for Bitcoin treasury companies, which, was obviously primarily MicroStrategy, especially for a long time, took like 3.5 years to accumulate 2% of the Bitcoin supply. And the Ethereum treasury companies got quite close to 2%, like 1.8% or something of the Ether supply in 6 weeks. So that obviously was tremendous buying pressure, driving the prices up, and all of these things basically combining to what we have seen, the price action. And a lot of it is solid and fundamental. The treasury companies will never sell, I mean, unless whatever, black swan. But basically, it's not like the ETF where you sell the ETF, you sell the Ether behind it. Here it's a case of, you buy it, you hold it forever. And so that's all good news, and that's all solid, and that's, that remains in place. The only kind of words of warning, of course, when you have a 3x run in a short space of time, you should expect corrections. I mean, I guess that's not a big deal. We have seen now some outflows from the ETFs. I mean, that wouldn't concern me. What is more concerning is that we have seen selling by crypto insiders for a while. So kind of as TradFi was buying Ether and Ethereum story through the treasury companies and the ETFs, long-term crypto, long-term holders have been selling into that, and the Ethereum unstaking queue grew to kind of the longest since when they first introduced it, and then the queue was long, then they worked it off. And the other sort of word of caution is that both Tether and Circle are building their own stablecoin specialist chains. So by far the two biggest stablecoins are actually building layer 1 blockchains that will be tailored specifically to be highly efficient at processing, serving the stablecoin use case. So that is a threat to, if this was a stablecoin summer for Ethereum, and it was more than that, and it is more than that, but to that extent, there's a question mark there, and of course, even more, I think, for Tron, which is, hinges so much, its revenues hinge so much on stablecoin revenue. So that's also, these chains are getting funded, and then they're gonna, over time, get launched, and then we'll see if they take market share, but that is something to keep in mind.
Right, exactly, yeah. And I mean, while they're being launched, they still have a road ahead of them, right? They need to build the infrastructure, they need to build DeFi. And having a stable coin is one thing, but then using it and getting a community to use it and adopt it is another thing. But it can go quickly, as we've seen, and I guess the market will tell us where this goes.
Yeah, I think the, Ethereum obviously correcting a bit, narrative is still firmly in place, just some words of caution, looking further. I would say I'm not bearish.
Of course, yeah. And I'll bring up a topic that we were going to talk later about. Well, I'll bring it up a bit earlier, and that's treasury companies, which you mentioned, right, with Tom Lee. And
I'm going to just go ahead and pause it right there for a quick second. Thank you, everybody, for tuning in. We're going to be streaming some panel discussions today from systemically important organizations, people that actually matter in this space with opinions, who are leading the charge in the revolution of this new financial ecosystem. So right now you're listening to Caitlin T. She is the head of Signum Investment Research in their crypto and digital asset department. That is now the second time that, coming from a financial institution, she has mentioned that she is still bullish, and that even given the state of the crypto ecosystem that we've recently seen, given the pullback, that she still expects a lot of upside potential and momentum still yet to come. Just pointing that out. We're just listening to the remainder of this particular panel discussion that was just released on Signum's YouTube channel just about 3 or 4 hours ago. Shout out to the CyberX researchers for giving a link to this one. But this is such a great panel discussion as she's giving some macro insights into what's going on in crypto and digital assets. After this, we're going to be tuning in to the SALT conference that has recently been taking place. It's still ongoing, I believe, as of today. I think it's going to go until tomorrow. We're going to stream the entire, let me rephrase that. We're going to stream as much of day one as I can stand to sit here and, stream it for you guys. So try to get through at least an hour or two of panel discussions, and then we'll finish the remainder of the stream tomorrow. But you're going to be listening to industry-leading experts from all major organizations, banks, systemically important, three-letter agencies, so on and so forth at the SALT conference. So definitely tap in. Let's finish out the remainder of this panel discussion with Caitlin and continue to hear what she has to say. Again, she's coming directly from a bank that is heavily involved in the digital asset ecosystem. So definitely tap in and pay attention to what she said. That is now the second time that I've heard her mention that she is still bullish in the overall crypto ecosystem. So, paying attention to people's insights who actually matter in this space.
This seems to be a trend that is continuing. I mean, you talked about a bit about Bitcoin, Michael Saylor, of course, and after Bitcoin being adopted by corporate treasuries over the past years, now there are Ethereum treasury companies popping up. What's your take? What's next? Solana, Avalanche. I mean, and where does this go? And what's actually fundamentally long-term, sustainably relevant in your opinion when it comes to treasury companies and this trend?
Yeah, I mean, I think it's a very legitimate trend, and there's actually, it's being done now more and more and more, a growing list of tokens, or all sorts of, Tomcoin and I mean Solana obviously for a while ago now, and I think even before Ethereum and Hyperliquid and even some meme coins and so there's a lot of it, and it's basically it's a product that transmits demand from investors that can't or don't want to directly access the crypto market. Basically, they buy these shares instead of buying the underlying crypto. So the question is always, sometimes, do they do that because they can't buy the underlying crypto because of you would need approvals or you would need whatever? Even if you buy the ETF, let's say you're an institution, you would need the approvals internally that this is a new underlying asset. When you buy a stock, you're just buying a stock, right? Like we've been buying stocks forever. There's no special kind of approval required. And then also because these companies have been able to, as long as these this positive spiral is in place of high premiums relative to their NAV in the token, the share prices have been accelerating very fast. So that also then it outperforms the underlying token. And so then it's also more attractive as long as this trend keeps going. So I think it was a very kind of a smart demand arbitrage and made a lot of sense. In a way, it's kind of an alt season. It's I think retail investors are buying these stocks instead of buying altcoins currently, and they're also buying sort of meme coins and other things that that retail gets into in later in the market cycles. They're not so much buying altcoins, to be honest, like we have seen before, but in this way indirectly they are, because this is then transmitted into demand and also takes the supply out of that token kind of permanently. So the question is just, and currently this trend is still in place. They're still raising a lot of funding. The fundraisers are still fairly successful and the amounts are large. But this will not last forever. It's impossible that this trend would last forever. So I think the question is just, when will we see signs that the trend peters out? There are some subtle signs. So certain fundraisers that we're going to close, by Wednesday, and then it doesn't, and sort of it takes a couple of weeks. So there are certain signs that maybe slowly the trend might be saturating. Also, MicroStrategy has been also issuing basically vehicles that are riskier for the company, because it's more straight debt, where they definitely will have to either keep raising new money or sell Bitcoin, which would be a sacrilege. But I don't see a threat really very much to the market. Eventually this trend peters out fine, then it doesn't make so much sense to buy shares instead of buying. It's better to buy the underlying token. Why take the risk that this could go to a discount, which they could and they probably will, and so on. I guess if I'm concerned, if I could say that, it's more just that this has been such a strong driver of demand, and this will run out. So then, that demand driver will kind of exit the stage, but without, causing any sort of problems. These projects are holding; they'll be holding the tokens. They won't be dumping it, and there can be, of course, very negative scenarios one can imagine, but they're not very likely, and it would kind of take a lot. So it's more just watching for how this trend starts petering out. For now, it's still in motion. So that's just looking further ahead. Right now, we see still big fundraisers by these treasury companies. So it has some more to go.
Okay, interesting, super. Yeah, and we'll continue monitoring this trend. Super interesting to see.
It's one of the things to really, really watch right now. Maybe one of the most important things to watch is the inflows and the buying pressure and how that's evolving.
Okay, yeah, super interesting. Yeah, great. We'll definitely keep an eye on it, and we'll talk about it here. One asset we usually talk about a bit earlier in this live stream is Bitcoin, and with Ethereum and everything. We've said this a bit, but when it comes to Bitcoin, I think price trends have been a bit sideways, but we really wanted to focus on one thing, that entering the year 2025, we had a lot of discussions on central banks potentially buying Bitcoin, right? This momentum seems to have vanished, and whenever momentum vanishes, it seems like might be a bearish trend. Or is this truly off the table for a lot of central banks, that they look into buying Bitcoin? What's your opinion?
Well, I like you say, the signs haven't been great, right? And this was a great hope, and I think such a hypothetically or potentially excellent use case for Bitcoin. I do think that it has its place alongside gold. In what ratio, one can question, but there's a lot of reasons why that would make sense. Except that the way things have evolved, this may no longer make sense for central banks. And in terms of the signs you mentioned, I mean, obviously we have seen just a lack of progress other than developing countries, making announcements that they're going to do it, but that doesn't really have a big impact on Bitcoin and the Bitcoin price. Maybe some Caribbean islands, implement that. That's if the US does it, and then various other like major countries, central banks do it, that's a massive use case for Bitcoin, and incredible price appreciation has to follow if that happens. And now we saw, first of all, the US government made various announcements that they're working on adding to this reserve, which is just to seize Bitcoin in budget neutral manners, which is the only way they're allowed to. And the announcement is coming. The market's gonna love it. We're about to do it. We're about to do it by Friday. We kept hearing this mostly from Bo Hines, who was kind of the point person in the U.S. administration, but it never happened. The expectation was raised, but then nothing actually happened. And now Bo Hines resigned. He actually joined Tether as an advisor, but he suddenly resigned fairly, I would say, unexpectedly. And then Scott Bessent in an interview said that we will not be buying Bitcoin. Now, that this, of course, the market reacted very negatively, and he then backtracked and put out a tweet to say, no, we're still looking into it. We're still looking into the budget neutral ways of doing it. But, the body language is not very promising, on that. And I think fundamentally where I see a genuine problem is that small US company, I mean, it's bigger and bigger because of its Bitcoin holdings, but as an actual company, very small, holds 3% of the Bitcoin supply of all Bitcoin issued, and in terms of the liquid supply on exchanges, about a third, and keeps buying more, getting to a half. So for any central bank to be beholden to a private company whose actions could dramatically affect the finances of the government is inappropriate. So I think that this treasury company story, which actually has so many benefits and in many ways makes a lot of sense, the fact that there is one single company, it's not even the treasury company trend, just that there is one single company that has such an influence potentially on the price of Bitcoin. Hypothetically, they say they never sell, but if you're the Chinese central bank or the British or the Bank of England or whatever, is it prudent for you to take that risk? So I think that this might be the lever and maybe the obstacle, and some kind of unless this is somehow worked out, it's hard to see that major countries' central banks would go for it, and the body language is that they're not.
Yeah, so that describes the status quo as of today, right? And who knows where that leads to 5 to 10 years from now.
Yeah.
All right, and that brings up to our last topic, not central bank related, but regulation related, right? The SEC and Project Crypto. Of course, we see tons of clarity with the White House, the SEC, and the CFTC proposals setting rules for DeFi, staking, and token launches. And of course, it seems all to be tailored towards a long-awaited alt-season and capital rotation into smaller tokens. Is that what's coming? Will this clarity finally fuel the alts season, Catalin?
Thank you for asking this as the last question, because it's nice to finish on something that's really bullish.
Okay.
which I think this really is the SEC's Project Crypto, obviously coming on the heels of the White House white paper, or I'm not sure, the White House paper that they were ordered 180 days to develop proposals, and this was now released. Actually, that paper disappointed in the sense that initially that was meant to have a strong focus on the Bitcoin reserve, which was barely mentioned. Just coming back to your previous question, in fact, the only place where it was mentioned, it diluted the language of the executive order, which said sees Bitcoin will never be sold, and now it says it will generally not be sold. So in that sense, the paper the market wasn't so excited about, but then there were all these policy suggestions of what sort of regulatory and legislative framework the White House would like to see for the crypto industry and various segments of the crypto market. And then the SEC and the CFTC immediately jumped on it. They're also collaborating, and the SEC announced their Project Crypto, and that's very positive, very, very bullish. They're really cleaning house like they said they would, but now it's happening. The liquid staking has been declared that it's not, it doesn't require registration with the SEC. And they're suggesting various things, for example, safe harbor for developers, which is somewhat contradicted by still this Tornado Cash developer being convicted. But of course, the SEC, it's not an SEC case, it was a DOJ case. So, I mean, there's limitations to, how far this goes. But as far as the regulator can make the environment as supportive and positive for the crypto industry, I mean, as far as I can see, they're really on it in every way, in clarifying the status of crypto assets, the disclosure rules, and make it very feasible and easy, and then specific focus on tokenization, creating, there's big questions around tokenization, and the biggest question I would say is the legal title and your right to vote, which you have when you hold the share, but currently not when you hold the tokenized share. And I think this could be a major stumbling block in terms of moving everything on chain, that the efficiencies probably wouldn't outweigh, when companies invest, especially large institutional investors, in a stock, they wouldn't want to give up their voting rights. I think this can be a stumbling block, but regulation can solve this, right? So regulation can spec things out that kind of make all of this feasible and workable in practice. Currently, it's not really workable in practice, but if there's a way, then that could, of course, really help unlock that use case. And of course, they're focusing on stable coins and so on. And like you say, because of all this clarity, it could accelerate innovation across use cases and beyond stablecoins and tokenization. And if it does, and there is real growth, real fundamental growth in decentralized projects taking market share and growing, that's our real alt season. Kind of a small hype where the high beta tokens outperform briefly, sure. But to have a strong, lasting, carries on for a while, lots of projects are involved. I think the SEC's actions, and of course the clarity, bill legislation as it kind of goes through, but this whole package and the CFTC, there's a potential that it could unlock a real fundamental alt season and a revival of various use cases and new use cases appearing and so on.
Right.
Dang, let's cross our fingers for that scenario, y'all, because just like you guys, I'm ready for that alt season she's talking about here. All right, so that's the end of this panel discussion. We'll wrap this one up. 845 people listening in. Really do appreciate you guys for tapping in with us today. We're just going to be streaming some panel discussions that we firmly believe everybody should be locked into and paying attention. We're going to migrate over here to the SALT conference live stream Wyoming blockchain symposium that just aired yesterday. This video surprisingly still only has 239 views. And on stage, we're going to be listening to some of the biggest industry-leading experts in this space, including three-letter agencies, systemically important organizations like major banks and financial institutions. And so if they say anything on stage, I'll pause it, briefly give my opinion on it, react to it in real time for you guys. But we're just going to tap in, pay attention to detail. These are the conferences and the panel discussions that you guys should be paying attention to, not the hypey influencers that are on the internet, always constantly filling your head with dopamine fixated price projections and theories on how price is going to get to where they think it's going to go. Listening to all the people without credentials in this space that just make content on the internet for entertainment is what's going to keep you poor. It's what's going to keep you distracted. It's what's going to keep you hoping for more when more might not be coming at the end of the day. You never know. Again, just pay attention to detail and listen to the people whose Opinions actually matter in the space. The banks, the organizations, the developers, the people who actually work at these crypto native organizations, these are the people whose opinions actually matter. And so here at CyberX and the Research Labs team, that is what we're always in an attempt to do and bring you guys is real research-backed information and not just this speculative, hypey bullcrap that's always circulating on the internet. So let's head over here. If you guys are watching this as a recording, do me a favor and repost this stream just so that way we can get this out to more people. We do appreciate the love and the support. I sent this message to Aqua to see if he can tap in, but it's still 7 a.m. his time as he is on the Pacific coast. So we'll see if he locks in with us here in maybe an hour or so. I'm going to try to get through as much of the stream as possible. That in which we don't finish today, we'll restream the second portion of day one of this tomorrow. And then all throughout the weekend and maybe into next week, if we can get day 2 and day 3 and maybe even day 4 going, we will stream those as well. Now, these are roughly about 8 hours long and they're filled with a whole bunch of panel discussions. So if a panel discussion comes on and I'm feeling like it's kind of dry and it's not really giving us any good information, or it's people that personally I don't really listen to or paying attention to, I'm just going to skip thoroughly through it and find another panel discussion that I do want to air with you guys listening in. So let's lock in. Let's tap into this Wyoming Blockchain Symposium.
Commentary on the industry, and I think this benefit Wyoming as well in bringing one. So recently relocated its headquarters to Cheyenne, so they're all in on Wyoming in addition to having the SPDI charter and all that. So I want to thank a few people. I want to thank just the state of Wyoming, or Wyoming Inc. as I call it.
Well, good morning, everyone. John, thank you for kicking us off. I have to say, this is absolutely hands down the best event of the year. This is such an amazing location, but I think most importantly, a really high-level group of people that are always people I want to talk to and bump into in the hallways. So we have a shortened time, it looks like, so why don't we dive right in? I think everyone knows Arjun Sethi. He is the co-CEO of Kraken and also the chair of Tribe Capital. And of course, Anthony Scaramucci, who needs no introduction. I want to touch on a couple of
Is that good or bad?
That's a good thing, maybe. But why don't we start with you, Arjun? I mean, I think, you know, this is about the state of the digital assets industry. I think the one big catalyst has been the change in regulatory environment. Kraken had a heck of a time under the prior administration. You've settled with the SEC. You were sued by the SEC. How are things looking for you today between the Genius Act and the White House's plan and the Chair Atkins speech? But talk about what that change has meant for Kraken as a company.
Yeah, I don't think it's, you know, relegated to just us. You know, there's headwinds in the industry for a long time, protocols, exchanges, everyone was trying to build on the crypto rails. So I don't think it was specific to us, but, you know, I don't think I'm saying anything new that people haven't said before, is that it's a new administration or protocol level. And we can kind of course correct along the way, as opposed to what we've been seeing in, you know, other countries where they're kind of notching. And you know, to their credit, outside the United States, they were ahead. And I think you're just seeing U.S. catching up and you know, moving, and that just kind of like, you know, pun intended, no pun intended, but like, you know, trumping ahead of the rest of the ecosystem.
Anthony, you always have stood at the center, at least in my mind, of the institutional world and the crypto world, and have been very involved in policy. And I remember last year we both attended a meeting in Washington with the Biden administration. They wouldn't let us into the White House, but they were kind enough to walk across the street and meet a group in a hotel. I know, right? It's like, look how far we've come. But
blindfolded too.
We've come a long way, and I think even you've given credit. I know this isn't your favorite president, but have given credit to him.
He's everyone's favorite president, according to the president.
But what? How do you think Wall Street are perceiving these regulatory changes, and what does this mean for the TradFi world going forward?
I want to go back to that moment that Kristen's talking about. So we were in the Willard Hotel, in the conference room downstairs. Incidentally, the same conference room was used yesterday, President Zelensky. So they recognized the room right away. And the Biden people came, they took notes, and they basically said to all of us, listen, we hate you guys, but we would like your campaign donations. Okay, and they said, okay, thank you. Then they left. And then Krista may remember we did a Zoom call with Treasury, and we said, listen, this Operation Choke Point 2.0 is wreaking havoc in the industry. They said, well, there's no such thing. And then somebody on the call said, okay, raise your hand if you've experienced some level of choke point 0 in your choke point 2.0. Everybody raised their hand. So it didn't go super well. And I would just say, this is real plaudits to the Trump administration for getting it. And again, whatever your opinions are of President Trump, and I've been obviously opinionated related to him, he has phenomenal political instincts. And back in July of 2024, he realized that the future of financial services and the mantle of U.S. financial services leadership is going to include this industry, of course, include Kraken, and you got to give him a lot of credit for that. And I think we've had a major sea change, and I'll go out as far as saying that I think it's a permanent sea change. I don't see the Democrats, at least the ones below the age of 55, wanting to go back to a Elizabeth Warren anti-crypto army. There's just no anti-crypto voters out there. So I'm hopeful that this will continue and it will somehow permanentize in Washington.
One of the trends that people were talking about last night is, obviously this convergence of crypto and TradFi. And Arjun, you at Kraken have been looking outside of the traditional crypto world. You're starting to look at tokenization. Can you talk a little bit about how you're thinking about these two worlds coming together and what the opportunities are?
Yeah, I think if you go back like 10 plus years, the whole promise of crypto was, let's get as many people access to capital, access to money, not just trading and speculation. And so this sentiment has been talked about year after year after year. And I think for us, when we took a look at the exchange, global liquidity, kind of global demand for assets, we saw that with stablecoins over the last 5 years, which is how do you start thinking about actually putting in real world assets, real estate, tokenized stocks, et cetera. How could you do it in a way where it's not a walled garden? And I think one of the things that we've seen is that if you go back for any of the exchanges, and it's not to put any exchange on notice, but the value sets that a lot of these companies have, they're kind of a wrapper, and they are just trying to extract value and keep the customers within their ecosystem. And I think there's some value in that in the short term. But what ends up happening is that it goes away from what the core was of why a lot of us started over the last 10 years, either invested in it or started protocols from scratch, which is that decentralization also just meant freedom to be able to do what you want, to be able to own your own assets and not have someone come in and say, well, you're a part of my AUM, or I'm going to rehypothecate it, or traditional banking. And so we kind of went back to first principles. I kind of say this again and again, even to our team, is if you take a look at the Kraken culture doc and like what we're striving towards is that we build products and then we drive profits from them to drive it back into what we cared about in crypto. And so tokenized equities, or that layer for us, was really important so that you could have non-custodial or custodial wallets or exchanges all over the world, DeFi or not, that could perpetuate real world assets and that global liquidity. So for us, it's like extremely important. And then on the convergence of the TradFi, it's more how do we bring those folks along the way to say, hey, like crypto's not nefarious. Yes, there was some speculation, but the word meme isn't a bad word. It's just more about like promoting this global liquidity that exists, not just in the United States, but all over the world.
Anthony, how do you think Wall Street's ready for tokenization? Do they see this as an opportunity? Do they see it as a threat? What are you hearing, and where are they at in the adoption cycle?
I would say some. I mean, obviously, Larry Fink is ready for tokenization. He sees the vision of it. I think that the traditional banks are probably going to take regulatory guidance from places like the Fed or the SEC before they move forward. But I think the central question is the technology better than existing technology? Can we move things more quickly, more efficiently from a cost basis? And can we move things more securely? And I think the answer to those questions are yes. And I think throughout history, anytime that the technology is better, we typically adopt it, even if there's some resistance. Remember, everyone in this room has been in an Uber, but there wasn't one government official in any major city that wanted Uber to exist. So it just, the forces are such where these things will happen, whether Wall Street is fully embracing it or not.
I think to add to that, you see what I get worried about is the Wall Streetization of crypto, right? You see the DATs, you see all these corporate treasuries, you're seeing SPACs come back into play where they're going to just start investing more into the ecosystem. I think that's well intended in some cases, but it's also it kind of reminds me of what we saw in 2020, 2021, where you just have a lot of fast money and sort of loose discipline around what's happening in the ecosystem because they're just excited about it. And you see these similar waves in like AI, et cetera. I think like the best thing to think about is like, how do we get traditional Wall Street or institutions to adopt and start thinking about building into crypto rails rather than trying to control it in a financial way? Because I think that's when the industry gets better. And one thing that I think everyone kind of forgets about is the billions of people that are trying to transact with these assets today. Like XStocks for us, I was surprised that it's been out for 4 to 5 weeks. I think we're like almost at like 3 billion in transactional volume. That just means there's a huge amount of demand outside the United States, and the United States prospers by just getting these types of products out there.
Yeah, no, I think as more and more products come online, and especially I think as it evolves to where people can hold their own assets and transact in DeFi, I think it's going to unlock a tremendous amount of
Well, even here in the United States, I want to be able to hold my stocks on my phone. Like I don't want anyone to control it, including Kraken, right? Part of it is we should be able to help proliferate that.
Chris, not to disrupt the flow, but I want to ask Arjun a question. Why Wyoming? Why did you guys choose Wyoming to be corporate headquarters?
So
help me out here, Arjun. I'm trying to boost this.
Yeah, of course. I mean, so we're fans, and I'm still looking for a house, and I haven't been able to find one that I can afford. I think it started. So I mean, the real story is Jesse Powell, who's one of our co-founders, had done a sort of I don't know if it's a lunch and learn, but some sort of Q&A with Senator Lummis, and she kind of maybe got pilled into crypto at that moment, or there was a lot of people along the way. But I think her and the team have just been a champion of what crypto means, and I think to a certain extent this might seem corny, but I think if you take a look at like sort of the values that what the American values are, or sort of our first 10 amendments, and like what it means to be like part of the American dream, I think like they did a good job of taking what we had said, like why we wanted to build sovereignty, and I think they just have gone to bat more than any other supporter in the ecosystem across the House and the Senate. And so they were first and foremost. They talked about Bitcoin. They helped us with the SPDI here. So they've been champions. And so I think for us, we wanted to make sure that we could reinvest into the ecosystem, bring more people here. I think Trevor's sitting right here is on the CEO for SPDI as well. The point was that like, where can we find states or folks that can be supportive, and we can do vice versa.
That's a great story.
I think we have time for one final question, maybe for you first, Anthony. You were very early with Skybridge in helping provide institutional investors ways to get exposure to crypto in a format that they understood. I think we're starting to see potentially soon new ETFs under a generic listing standards. We'll see more tokens be available in the ETF format. We're seeing the rapid proliferation of digital asset treasury companies. And we're also seeing a lot of companies either IPO or go public via SPAC, et cetera. What does this mean to you? I mean, to me, it seems like there's a huge demand that people want to invest in this space. But talk about sort of what you're hearing from your
Well, I would break it up into a few categories. I think there's a store of value category that I've been, but if you're a bull on Bitcoin, you think that's going to happen, and you've got a large group of people at a place like BlackRock selling that idea to big institutions. And I think the second category is related to utility and tokenization, and will these protocols be used to bypass the third-party transaction system. So if you just look at that system, there's approximately $7 trillion of third-party verifications that go on, credit card fees and et cetera. So I think if you look at those two separately, you say, wow, there's got to be huge demand for both.
Yeah, I have a little bit of a different take. Is there's so many people here as well, and we're all working towards this ecosystem, is that Bitcoin is a protocol network, right? And I think a lot of people kind of forget that we're still building against that technology. There's a set of folks that are, they think of it as a store of value, and there's a set of folks that are still building on top of it, right? So there's this new meme generation that's happening on Bitcoin, but that also means that there's new types of technologies that can be built on top of it, then bridged against it, new sources of liquidity. I just think that we're so early in the ecosystem. What's going to happen across not just Bitcoin, but the rest of DeFi? It's really hard to fathom what's going to happen in 6 months to a year. It's more about like, how can we continue to race to support all that development that's out there? And so when people say like, oh, I think it'll be which is like, hey, gold is worth this much. Okay, well, like it could, we could be, 100x, 1000x more than that in terms of like what the value of all these assets are going to be.
Wow. I'm going to run that one back. That was the first excessively bullish and like mind-blowing thing that I've heard this entire panel so far, where he pretty much just said that nobody really has the valid credentials to say what this space is going to do. And compared to where we're at now, being early in this space, who knows if it's going to 100x, 1000x? We are early. And that should put things into perspective for you guys on these market cycle narratives that still exist in the space, where everybody thinks that the crypto market is going to act the same way that it has over the last 16 years, over the next 50, considering that now for the first time ever in crypto history, we have the largest jurisdiction and governmental entity in the world supporting crypto, along with the political aspect of the United States supporting crypto, coupled with institutional adoption and clear regulatory alignment. All three catalysts in which crypto has never seen over the last 16 years of its infancy. I really, truly don't think that anybody has the right credentials or framework to really put into perspective what's going to happen for our portfolios and for what altcoins are going to be the ones that survive and thrive. The best thing that we can do is continue to do our due diligence, our research, and adapt to the changing market conditions, right? So I'm going to run that back about 30 seconds and just listen to, again, what this gentleman here has to say. And I believe this is a gentleman, if not the CEO of Kraken.
Final short answer question, Anthony, what are
it's really new source still building on top of it, right? So there's this new meme generation that's happening on Bitcoin, but that also means that there's new types of technologies that can be built on top of it, then bridged against it, new sources of liquidity. I just think that we're so early in the ecosystem. What's going to happen across not just Bitcoin, but the rest of DeFi? It's really hard to fathom what's going to happen in 6 months to a year. It's more about like, how can we continue to race to support all that development that's out there? And so when people say like, oh, I think it'll be which is like, hey, gold is worth this much. Okay, well, like it could, we could be, 100x, 1000x more than that in terms of like what the value of all these assets are going to be.
Final short answer question, Anthony, what are you most excited about for this conference? Who's your favorite guest that you might be seeing this week?
You're my favorite guest.
Well, okay, you're second.
Stipulate that right away. And then the thing I'm most excited about is people getting to meet each other and hopefully ending up doing some business together.
Arjun?
I came only to see Anthony.
You could have said I was your favorite guest, Arjun. I would have been never at.
All right. Well, I'm getting the red light, so thank you, everyone.
Thanks,
I'm really
guys.
excited about the content today.
We're early.
I think I'm in the correct seat here.
I think you are. Yes. They say go to the center seat, so I'm not sure. To me, I'm on the right, so I'm used to the center being on the right, but this
Yeah.
is the center today.
I think you got it.
Is that
Does everyone to just work for?
All right, good morning, everybody. Good morning, good morning, good morning. Welcome to the Bitcoin mining panel sponsored by Aquapana Water. Everybody should have their Aquapana. Just want to thank Salt, want to thank John, want to thank Anthony for having the Bitcoin miners up here. As many of you know, a lot of the industry had given up on Bitcoin miners, but unlike Bitcoin treasury companies, Bitcoin miners can actually create new Bitcoin at a price below the current market price. And actually the network can't run without Bitcoin miners. So in my opinion, we have four of the very best companies, public companies here in the space.
But
Sorry, guys, to save time, I'm not going to stream the Bitcoin mining panel. Not that I'm not interested in that, but there's other people on this panel discussion list that I want to get through. This next one is going to be the CEO of Franklin Templeton. So let's take a second and listen to this lady here.
The idea of genes. Good morning, everyone. Mass exodus. Unfortunately, going to miss the best session because of my guest today. That is Jenny Johnson. Jenny, I have to tell you, I know you're around ranches and horses all the time, but the idea of jeans and boots on stage for me, I'm like itching, but I'm trying my best.
I was in it yesterday, but
Yeah.
I didn't want a photo.
So we only have less than 15 minutes, but I think this is a really important conversation that maybe is an exception to most of the day, which is a traditional asset manager and with their role, with their opportunities, and with their ideas and the future of cryptography and blockchain and cryptocurrency mean for that TradFi. And you've been really a pioneer in that. So I want to take you back. We were on a park bench. It was like mid 2020. So you can imagine we were meant to be social distancing. I'm sure we were breaking all the rules. And I remember you said something to me that you've now been on the record lots of times and saying that every time we start talking about the opportunity in blockchain, it inevitably ends up in Bitcoin. And you weren't saying I don't want to talk about Bitcoin, but the problem was it was just distraction for what you called possibly the greatest transformation in financial services in a generation. Maybe I'm putting words in your mouth, but talk me through why that was such an early epiphany for you.
Yeah, so what I said was, look, Bitcoin is the greatest distraction from one of the greatest disruptions that is coming to financial services. And I think in this debate about Bitcoin, which to me is like a religion at this point, right? You can argue whether it's real or not, it doesn't matter. And I have come to the conclusion that because it's a great fear currency, and when I say that, if you're from the US, you don't really think about this, but you travel internationally. And I remember talking to somebody from Israel who said, my parents and grandparents had their money taken away by the government. They will always keep a percentage of their savings in Bitcoin. And they're not going to put it into Bitcoin ETF because the government can reach that, but they'll keep keys for their Bitcoin. And then talking to it in Bitcoin. So that in my mind gave me like comfort around this floor. But the point on the blockchain was, it is such a, from a technical standpoint, I ran technology for a while, it just as a program, as a programming language, it does really important things, right? And these are things in financial services that are going to be significant. Anybody who's run a financial services company, we spend a ton of money reconciling data between systems. Boom, that goes away, right? There's this batch process. All these products and back office are, because we're sitting there's a bunch of mainframes. I'm pretty sure every major bank out there is still running a mainframe, and you batch process. And so why does the New York Stock Exchange close at 4 o'clock? It closes so everybody can reconcile. What Bitcoin does is you have atomic settlement. So you're going to settle immediately. And then the final piece is you don't have to worry about who the counterparty is on the other side. When we do an FX contract, we'll use a major bank because we don't want to worry about whether we're going to get paid for with that counterparty. But if you have it in blockchain, one, because the token can prove ownership. Two, you can get paid immediately, so you have atomic settlement. And three, the smart contract can execute it without people interfering. You actually don't need that intermediary. So that drives down costs. It's more secure. And I was talking to Anthony this morning. He said, well, what about quantum computing? Remember, when you worry about quantum computing, you're also going to have quantum security to offset it. So I feel like that will evolve with it. You have transparency. Regulators are going to love it. For all that they're afraid today, they have tremendous amount of transparency, more than they ever. And you add AI to that, and it's going to be a great way. They're actually they're going to fall in love with it. Efficiencies like atomic settlement, and then finally operational cost efficiencies. Like in the asset management business, there's only one way fees are going, and that's down. So we have to constantly evolve to be more efficient. And so it's going to open up. It's going to have cost savings, and it's going to open up a bunch of investment ideas and opportunities that people haven't been able to use today because of the technology.
So Clayton Christensen, good Salt Lake City boy, where I live now, of course, has the famous innovator's dilemma theory. And I'm curious, in your boardroom, in your executive team, and just you as a leader thinking through the reason that traditional incumbent firms struggle with change, disruption, innovation, is that there are real revenue disruptions. There are real risks. You are creatively destructing your own business, which is extremely difficult to do for the benefit of the future. How have you led through that and even managed your own fear?
Yeah, so I actually think this is one of the issues or one of the challenges of public company CEOs. So first of all, I'm third generation. My grandfather started Franklin Templeton. So I do tend to think generationally. Like, I don't want to be the one where they're like, man, we had a really great thing going until Jenny missed that obvious trend, right? And so you do have to think and balance it with what has to be done today, right? And so I think that's every CEO's challenge. And the reason I say the public company is tough is because there's so much pressure on quarterly earnings. And the work, we started doing stuff in blockchain in 2017, 18. We launched our Benji tokenized money market product and I think approved by the regulators in 2020 or 2021, these are not going to be meaningful contributions to our earnings probably for 5 years from when we started or more. You know what? Most CEOs are going to say that's the next guy's shift.
Yep.
I'm not going to make this investment today because I got to deal with the quarterly earnings. So that's one mindset that I think that's why private companies often can think a little longer. And then the second piece is, so then when you have these folks who are really excited about this technology, by the way, they tend to be really disruptive to the rest of the firm. The rest of the firm's like, yeah, that's all great, but I got to get my sales numbers now. I need to get, the NAV done at the end of the day. I'm not going to talk about that stuff. And so you have to almost, and we're doing it with AI, you almost have to.
So let's talk a little bit about this laboratory. You mentioned Benji already, which first 40 Act.
It's tokenized mutual fund that is on the public blockchain. It's the only one on it. We are running it on the public blockchain.
Okay. And you've been talking with MAS Singapore, I've seen in the public domain as well. About down the road. What's the roadmap from here?
There's a lot. I mean, so I genuinely believe that mutual funds, ETFs, all happens, right? When I use that foreign exchange, we pay big banks a lot of money to execute a foreign exchange contract. As you eliminate that, and you can drive down the cost, a couple things you can achieve. One is our tokenized money market fund, you can subsidize this. The larger investors don't want to subsidize the small investors. That doesn't happen when you put it on a really efficient rails. And so I think that it's gonna naturally happen to all the traditional products, and then it opens up new investment opportunities because you take out the frictional costs, you can start to create song rights. I love the Rihanna example. Didn't really work that well, but there will be these types of things where she issued 300 NFTs, each worth 0.00033% royalty, the rights to the Bob Marley, library of songs and things. And so there's going to be a lot new interesting products. And then this atomic settlement. So with Benji, we're a regulated money market fund. We have filed it in every jurisdiction. We also have a private one too. We're working so that you'll be able to move from stable coins into the money market fund. And you can do that to see that happen.
Rihanna is your ringtone when you call me. You realize it. Can we dream even farther, though, when we talk about tokenizing mutual funds, ETFs? What about, you talked about the friction of the 4 o'clock close for reconciliation. Do you foresee a world in the short, medium, long term where public equities, public treasuries?
I mean, I'm pretty sure Brian Armstrong at Coinbase has been talking about this. I think he did it in Davos when we were on a panel. And why not? All he has to do is hold an inventory. It's almost like an ADR. And you could trade 24/7. There's already after hours. Why wouldn't you want to trade and get atomic settlement? Why are we waiting T+1, T+2? Like, it makes zero sense. And we're waiting because the infrastructure doesn't support it. But naturally, I actually think that as the regulation clarifies, right? Because that's been the key. As the regulation clarifies, those that have the digital assets will start to offer more traditional types of products. And it'll be 24/7, 365. Mm-hmm. And, I don't know how fast that comes. I think regulation, the technology exists to do it. Regulation is probably the biggest inhibitor to that happening today quickly, but it's happening. It's going to happen.
So let's finish with that. So I imagine most of the speakers that you're going to see through the course of the next day and a half, this regulatory legislative environment is existential. I mean, it is very acute, as you heard from Kraken earlier. For someone like Franklin Templeton, clarity and liberalization around the regulatory structure, how does that change what you're doing? Does it accelerate some things, not others? Does it give you more comfort? Or does it not change anything that you do?
I mean, we're a highly regulated entity, so we've got to play by the rules. Now, that's been at times frustrating because I think it's in trying to do that, because we don't want to risk the rest of our business, we've allowed these unregulated entities to take off, right? But if you actually put yourself in the shoes of a regulator, guess what? There's no upside to getting regulation right. Nobody goes, hey, that guy was really ahead of himself, right? But by the way, if you get it wrong, you are literally crucified. I mean, everybody complain, you should have known, you should have seen it. And so unfortunately, regulators are not in the position to take a lot of risk on where this is going. And let's face it, there are a huge number of digital assets that even all of you in this ecosystem will say, I don't see it. That is going to blow up at some point. And so if you're a regulator, it's so hard to define the rails to be able to deal with that risk. And that's why I think it's going to be slow. And I think the good news is you see we've worked a lot with regulators all across the globe, and I would say they've taken different approaches. Like an MAS in Singapore has a sandbox, so as long as you're working within it, you're protected, but it's not something broader than that. Hong Kong has been very aggressive on trying to be very prescriptive. UAE, same thing. And so there's a little bit of competition with each other, which I think is healthy. And they are also talking to each other to learn from each other, which is good. But listen, I don't envy the regulators because I think this is it's a bit of a challenge. On the other hand, if you don't start to regulate, you put the consumer, which is who you're designed to protect, at risk because the consumer is now entering a completely unregulated zone. And that's not a good thing either.
Yeah. So very last thing, for the investors out there, is there, and you can't say Franklin Templeton, but is there any category?
Who says I can't?
Any category of this ecosystem as an investor that you think is the most exciting? Tech layer, killer app, infrastructure, picks and shovels. What is the most exciting area?
Yeah, I mean, look, I think the picks and shovels and sort of the baseline of the strong, layered apps like you always, if you were mining for gold, who made the most money? I mean, there were some people who made it in gold, but most people, it was the guys who sold the picks and shovels. So I like the rails as a sort of starting point. And then there are some really great consumer apps that are coming out that I think are really interesting, which by the way, I tell my equity guys, you should pay attention to this area because some of these companies are going to disrupt, and you're only looking in the ecosystem of sort of the traditional, and there's going to be disruption to those companies. And then final thing, we're a node validator, and I think a public equity, all the transactions that go in and out of that company and how much information that gives you. And so we, provide research on, I think 30 different coins. And our view is if you are not playing in the ecosystem, you actually cannot possibly have the insights and so that, again, that transparency point, it's pretty amazing to be playing in that space.
Well, that was a whirlwind, unfortunately, Jenny. Thank you so much. I wish we had more time. It's red already, but let's give Jenny a round of applause.
Okay.
Next panel looks like we got individual representatives from XSY, Anchorage Digital, Paxos, BNY Mellon, and Securitize. So this should be a juicy one. I thought that the Franklin Templeton, Jenny Johnson panel was going to be a hot one, but honestly, she didn't say anything that I didn't already know or that she hasn't said in previous panel discussions. So hopefully these next panelists say something worth our time. Let's check it out. Either way, still, Franklin Templeton, Jenny Johnson, always giving some really good insights. One key takeaway that she did say is that regulators are going to fall in love with this technology. And that's a major shift and change in the tide and the tone in the space, where over the past 16 years, we've been dealing with regulatory headwinds. As a matter of fact, in this specific conference, the SEC chair, Paul Atkins, actually states, which I think his panel's coming up in the next hour or two, but he specifically states that the vast majority of cryptocurrency assets are not securities. And he said that live on this stage. So huge shift in the regulatory undertone. Again, we've never seen a digital asset ecosystem with full regulatory clarity. I feel so bad for the people that still think that the 4-year market cycles that have existed when retail is primarily driven, the volume and volatility in the digital asset space are still going to exist over the next 20 to 50 years. Who knows what that environment's going to look like? But again, just make sure that you guys are doing your research on how to protect, how to preserve, how to grow your wealth, how not to have to sell for fiat currency to get stuck back into the traditional system by capitalizing on DeFi strategies and learning how to get your digital assets working for you. I can't stress enough that as we enter and progress continuously through this digital transformation, your knowledge is going to be what really puts you ahead of the rest of the crowd, not the speculative hype stuff that existed in prior cycles. So let's lock in with this next panel.
To have the honor of having a nice conversation with these 4 battle-tested professionals in the crypto space. And we were joking beforehand that of all the panels, I mean, if you wanted one where you could kind of count the scars, this one has plenty of them, and I think well-earned. So I want to just give a chance for everyone to introduce themselves. Maybe we'll start at the end with Carlos Domingo.
Sure. I'm Carlos Domingo. I'm the CEO and co-founder of Securitize, a company that focuses on tokenization of what they call today real world assets, which is a newer term in the industry. So we've been doing this for a very long time, and we primarily focus on serving the large, traditional asset managers to bring them on chain through, the licenses and the technology that we provide.
Great. I'm Carolyn Weinberg. I'm the Chief Product and Innovation Officer at BNY. And as part of that, digital assets is a key part of our strategy, enabling the ecosystem of digital. Prior to that, I was the Chief Product Innovation Officer at BlackRock, where we did quite a lot in digital assets that I led with many amazing partners that you probably know. Prior to that, actually, was in the sales and trading business. I ran fixed income derivatives businesses at various firms, so know very well the collateral markets, which we're going to talk about at some point. Prior to that, I worked at McKinsey, so take a very strategic mindset to all the things that we do, and I'm very excited for this conversation. Thanks for having me.
Thanks, Carol. I'm Walter Hessert, the head of strategy at Paxos, and at Paxos we are building regulated blockchain infrastructure. We power a lot of the largest enterprises in the world with their blockchain solutions, whether it's Bitcoin trading and wallets, stablecoin orchestration, and of course stablecoin issuance, which we've been issuing various stablecoins out of our New York Trust and other regulated entities going back about 6 years. And today we issue a handful of different stablecoins, always operating at the infrastructure layer, one for PayPal, PYUSD, and USDG for the global dollar network. And Paxos is always really focused on being regulatory first and focusing on the infrastructure layer, serving large enterprises.
Hi, everyone. I'm Nathan McCauley. I'm a big fan of Wyoming. Spent the last week in Yellowstone, so enjoying it. When I'm not vacationing with my family in Yellowstone, I run Anchorage Digital, digital asset custodian that builds a bunch of infrastructure for institutions to participate in digital assets, whether that's on custody, trading, stable coins, or settlement. And so we have a whole suite of offerings that allow institutions to either directly participate in the digital assets ecosystem or build on top of the infrastructure that we provide for them.
That's great. And so I'm Sean Ford. I was one of the founding team members at Algorand and have launched a new project on Avalanche a couple of months ago that's in the digital asset and yield generation space. So just to start this, I know there's been a lot of talk about the recent legislation that has been passed, which has provided, I think, some degree of sure footing for all of our businesses. I want to push past that because I think everyone here would probably agree that's a minimum requirement to having the United States in particular start to take its place in the stage as a leader in blockchain and crypto. But putting that aside, what do you all think is the next big barrier to adoption?
Sure, I can kick off. I think with regulatory clarity in place, one of the things I think about is that the Oldsmobile first started building cars, and when they designed the cars, Ransom Olds, the founder of Oldsmobile, figured out that he had all these wonderful cars, but there were no roads, and that's where I feel like we are now. We have the product, we have the regulatory clarity that we can deliver these services, but we don't have any of the roads. So much infrastructure needs to get built, integrated into financial services, and into fintech, into the tech companies, and so that's really the stage that we're at now, right now, where like the car has been invented, but we need a bunch more roads to come into existence.
Carolyn, what do you think, based on your background, sort of spanning both sides of the
Yeah, absolutely. I think so at BNY, we are the financial infrastructure today for the markets. I think, as many of you know, we are one of the largest custodians, or the largest custodian, as well as we do $2 trillion in payments and so forth. And why I'm excited of the work we're doing at BNY related to blockchain and digital is that we're taking traditional and looking to the future. And I completely agree with Nathan. The future is very much about actually enabling that whole ecosystem. It's not just about one thing or another, it's about how the systems fit together. And that's how actually our financial system works today. So that's a huge hurdle, if you will, but it's also where, when we see the mainstreaming of digital and a lot of the banks and a lot of the regulation coming into play that enables us to all do that, those rails going digital will enable us to actually scale. I would say one thing from talking about battle scars earlier, is that we need to make sure that we're doing this in the right direction, so we set the foundation for acceleration. The biggest hurdle will be if there's like a real failure in the system, we go too fast, or we expect something that doesn't actually work. So I would just say we should be really thoughtful, think through all of the different second order effects as we have make sure that we are protecting the future by not doing things too fast, but going at the right speed for that acceleration.
I just think that part of the problem for adoption, once things like, the Genius Act has passed, so stable coins now are kind of legal tender, and you have more clarity about tokenization, etc. It's also kind of like abstract the technology out from the users, right? So if you remember, in the 80s or early 90s, when you had to connect to internet, you had to download a TCP/IP stack, and then you have to download the modem software, and then you have to click and then wait and to then connect to internet, and you have to do all this stuff to be able to access the internet, and that worked well for the early adopters. And in crypto, we're kind of there. Like, if you want to use crypto, you have to download a wallet and figure out how to activate it, and then sign transactions and deal with a horrible UX for, moving things across multiple blockchains because you don't know which one you are. And, at some point, these technologies need to be kind of abstracted out, because BNY provides you a digital wallet, and it's there, and you don't have to deal with these things, or the phones already have the wallets there, and then, you open your phone, and your phone is connected to a blockchain, and you don't have to deal with the connecting it, etc. And until that thing happens, the mainstream users, of course, there will be the most sophisticated tech users, early adopters, etc., that will go through these barriers. But to go really full mainstream, you need to abstract this out from consumers.
Yeah, I think Carolyn, you've been at the helm of two of the pioneers in the space, and so they have plenty of battle scars, as do we from the industry side, from the digital asset industry. I think that the reality is that for every BNY, there's another dozen. The mass market that you heard a lot in the market. Oh, we don't want to be first, we want to be second. But really, what they meant is we don't want to be first. We want to come after it's all clear, the regulatory regime's in place, the legislation is there, and first has been out there long enough to take all the battle scars. And that's just now. That is now. And so I think everyone in the market, no matter where you sit, whether it's on the regulatory side, whether it's on kind of the incumbent financial services banking side, or in the digital asset space, I'm sure everyone is feeling the same thing, which is everyone is now moving to this wave of investment in this infrastructure, in this adoption. And the industry does continue to grow. It's growing every day. It's just we're talking about what makes it grow orders of magnitude more. And that all kind of happens together, and this wave is one of the big catalysts.
So can we stay just on that for a second, Walter? So Paxos has applied for, is it a registered charter, banking charter trust license? Is that what it is?
A national trust bank from the OCC.
And so do you see that as and you're the third, sort of crypto-based or crypto-native company to really do?
Well, there's one now, that's Anchorage.
Right.
And we hope to be the second.
Was coming to you after this, Nathan. Thank you. I appreciate that.
Good friends. Thank you.
Yes.
He started to squirm a little bit.
Yeah, that's right. So I guess both of you then can comment on this. That do you see this as the start of a breaking down of the walls between TradFi and DeFi? Like this type of action?
I think breaking down the walls, that is a fair way to put it. I think that it really is going to advance the technology in the industry in a way that benefits kind of all. Really lifts all boats with the condition of boats that are willing to be innovative and move with the market. Yeah. The market's moving. The market has already spoken that there are aspects of crypto and blockchain and digital assets that it wants. And we have built businesses that are kind of natively built to serve that demand in the market. This allows us to operate at a much higher level and serve larger enterprises and more mass market. At the same time, you have all of the big players that are incumbents, and they have massive platforms, they have massive AUM, they have massive customer bases and brands, and they're going to innovate too. And in some ways, they've even been, we may have felt it in a different way because we didn't have an incumbent, successful business, but in some ways, they've even been held back more by the lack of regulatory clarity than us in the digital asset space.
Nathan, do you have anything?
Yeah, I mean, I would just think of, I think it's telling that we have BNY here on the panel with us. BNY is probably the best example of adopting technology for the entire history of banking within America. And so this question of is TradFi going to break down the walls between DeFi? I think these two converge over time. TradFi becomes DeFi, DeFi becomes TradFi. We had uncertificated stocks for many, many years, and then we moved them onto ledgers and got to faster settlement. And I think we're going to see the same thing in digital assets. Another thing that I think is going to be really interesting here, I think it's at least poetically beautiful to me that the OCC was actually established by Abraham Lincoln to.
I'll pause that real fast. That one caught my attention. He specifically said, he being a gentleman, I believe this is the CEO, or I don't remember his credentials, escape my mind. He stems from Anchorage Digital, institutional custodial provider in the digital asset ecosystem, just said that from his perspective, he thinks that TradFi is going to become DeFi. DeFi is going to become TradFi. Everything's going to merge, right? And so looking at the landscape now where the two are separate, that gives you a perspective on how big this ecosystem is going to grow, considering that the gentleman before from Kraken mentioned how early we are and how DeFi is still a 100 to 1000x opportunity from where we currently stand. So again, just giving you guys institutional insights from people's perspectives who actually matter in this space. These aren't speculative, hypey individuals giving you guys bullish moonboy price predictions. These are people who are actually building out the core infrastructure to onboard financial institutions who are telling you guys, hey, look, this opportunity is huge and it's not one that you're going to want to miss. So really great perspective here from this guy. Let's continue to listen.
Figure out how to bring the dollar into a common understanding of what the dollar should be in within the US. And now with the Genius Act, the OCC has been given that charter again to decide what are the regulated stablecoins, how should the large, thoughtfully built stablecoins actually operate. And so there's echoes of the original reason the OCC was established in the late 1800s. They're now present today in its expanded remit.
That's great. And I just want to point out that you've now had Oldsmobile and what happened with that, and now you've talked about Abraham Lincoln. So there's a high hurdle for all of your references.
I'm going to be here all day.
Historical.
I got more.
Let's keep going to keep his place. That's right. The Rough Riders next. So if we could, I guess I'll just ask what your opinions are around the shift of stable coins, at least as I've seen them, or digital assets have been sort of side projects. They haven't really been core to strategy. Stable coins in particular have been interesting things that a number of pioneers have sort of taken a lead on, but have not become core. Do you see the strategic discussions shifting now where when you plan your strategy or when you see people talking in the market, is this CFOs now saying, I need to sort of plan stable assets and stable coins as I go forward?
Yeah, maybe I'll. So as like head of product from BlackRock and head of product at BNY, sometimes we think about like beautiful products, but actually no one's going to use them. And I think when we think about the evolution of stablecoin, it's one of those things. Like, how can you use it? And how can you actually take the structure of the fact that in many ways, if you break it down, you have a tokenized money manager of treasuries, someone's holding those treasuries. And as we talk about interoperability, ultimately you just have treasuries moving around if you're going from one stable to another, or actually treasuries are staying somewhere and you're moving. So it's very similar in many ways to other things that we have. But the question is, like, why do you want to do that? Why do you want to move money fast around the world? And there are so many amazing use cases for that. And the question is as you start to look at the pools of assets and these important use cases, whether or not you're a CFO or trying to manage your money from a company perspective, gosh, wouldn't it be nice if I had one account and didn't have to have revolvers all around the world to support my working capital variance of risk? So if you can reduce that time period, you're actually adding value. So capital efficiency, liquidity, speed, all of those things can enable stablecoin to grow. So the coin's out there because, again, it's about treasuries, it's about tokenization, and it's about money management in a way that's really smart to make the system work.
I think that, because you have to move two ledgers, right? You have to update the ledger that tracks the securities, the ownership of the security, let's say a treasuries or a money market fund, but you also have to update the ledger that tracks the dollars that are the counterparty to the transaction, right? And then the fact that now we have this single ledger technology that uses the same underlying representation for dollars and securities is a huge advantage. And when I started doing tokenization, stablecoins didn't exist. Like USDC was launched in 2018, Tether was $3 billion, I think, AUM, and it was the tokenized money market fund project at BlackRock. And then the advantage of that money market fund, tokenized treasury fund is that you also have stable coins as a counterparty to the fund to be able to invest and to be able to redeem the fund quickly, right? So one without the other are handicapped. And I think now that we have stable coins that are, legal, and we have also clarity towards about tokenization, the role of transfer agents and broker dealers for custody, et cetera, then I think that this is when the market will really expand.
Right. What about you, Nathan? You've called it, Anchorage has called stablecoins core plumbing.
Mm-hmm. Yeah, I think it's kind of interesting to think of whether they are core or not. Certainly, if you're looking at it from the TradFi angle, the stablecoins are not yet core. They're kind of the new up-and-coming player. But if you actually take the orientation of looking from the blockchain space, right now, over half of blocks mined or staked or added to each of the various blockchains that are popular are at least one part of the transaction is denominated in a stablecoin. And so they are actually the main way that blockchains are being used right now. Majority of the block space is toward stablecoin related transactions. And so, I mean, within tech, the never-ending story of tech is when you see something that is 10 times better than the existing infrastructure, it is almost guaranteed to succeed. And anybody who has touched stablecoins, anybody who has transacted with stablecoins, anybody who's moved stablecoins understands that they are 10 times better dollar. And so that's not to say that they're worth $10, but they are way more useful, way more convenient. And when you start to see these things, you realize there's a certain inevitability that comes to the adoption of these kinds of things.
The 10x kind of like paradigm does like create a interesting adoption dynamic where you have some of the largest platforms, the largest businesses in the world that have very global platforms market, and it's an internal ledger move for us. It's like if you get the tier down, then they're like, this really impacts our business and we get it, and it has to be core because this is going to save us a lot of money. And then what happens is that then brings it, you know, to the end customer. The end customer demand grows, and then those big platforms say, "Hey, now our customers want it, or our customers are going to want it," and so we have to start making it core to our operation. And so it really is an ecosystem. You can't point to like any specific thing that is driving, you know, kind of how enterprises and how the different institutions that are adopting it, how they're valuing it. It is really across an ecosystem watching this huge adoption wave take place and driven by a bunch of different factors and different value propositions for different cohorts.
So I'm going to ask Carolyn another question, which is, I think, so BNY has just been selected to custody stablecoins. Can you talk a little bit about how that process evolved and, you know, what your experience was in the decision-making around, you know, taking that step?
Sure. So for quite a while, we've been enabling stablecoins, Circle and others. The announcement, I think, is Ripple, Open Eden recently as well. What we're really focused on is the enablement and the ecosystem. So how do we actually think about this concept? We said there's treasuries underneath. You need bank accounts, you need payments. So all of these things we do to enable the stablecoin. We sort of inside, we call it stablecoin in a box because we actually can enable all these things. And we have lots of partners around that do much of the pieces as well. And together, what's important is that this is about better rails. And I think Nathan said it as well. We really, if there's a pain point, if you will, for a client, how can these rails enable that? So from our perspective at BNY, what we're really focusing on is how do we enable the stable coins to actually save our clients money, to create better, cheaper, faster ways, reduction in capital and these efficiencies. So that's one really important thing for our clients. And the second thing is the role we play in this central position. Our vision is that by being the custodian for and the enabler and manager in some cases for the treasuries of these stable coins, we can ultimately in a future state interoperate between all of them. And that interoperability, imagine a world where you have treasuries in one stable and treasuries in another, all sitting at BNY. It's a book entry in many ways. The question is, how do you have 24/7 treasuries? Or if you have a cash account and a cash account enabling between inside BNY for the tokens to move 24/7 and the underlyings to move 24/7, that's what we're focused on. So what we're comfortable with is enabling our clients who are stablecoin issuers, who are settlers of transactions. We have 55 trillion in assets in custody. Imagine if all of those wanted to trade on blockchain within the BNY network or outside. That whole system, if you will, can be enabled through BNY. And that's what we're focused on. So hopefully that explains it. But imagine if there are loads of stable coins and everything could just move in ledger within BNY from treasury to treasury to treasury, from one to the next. That's what we're focused on. That's what we're trying to help, and to scale stable coins and then yielding coins, if you will. So Carlos brought up a product that exists that's yielding of stable coin. It's the same investment guidelines as a stable coin, but actually gives yield. So imagine just going back and forth, checking account, savings account, checking account, savings account. Ultimately, we would love to be able to do that for the system. And that's how we're comfortable.
And that's the premise of Liquidity Direct.
So what Liquidity Direct is a great point. Today, we are the largest enabler of loads of money market funds. So any institution who wants to put large amounts of money into a money market fund or switch between them, they do that through Liquidity Direct today. And what we've enabled is that some of these very large money market funds, they have share classes now that we've tokenized. We've done that in partnership with Goldman Sachs and some others. And the key is that a stable NAV money market fund that is a share of hundreds of billions of dollar money market fund, that's actually quite a nice payment rail as well. So we can think about tokenized deposits, tokenized treasuries, stable coins, and tokenized money market funds. All of those are great payment layers on chain to enable this instantaneous. And again, the faster we can move the underlying, again, if it sits in BNY, we could in theory move from A to B instantaneously. Therefore, we sort of see how it all fits together. And that's what the money market fund tokenization concept is. We talked about walking before running. For those who see those brand name money market funds, including our own Dreyfus, BlackRock, Federated Hermes, there are a whole bunch of them that we announced in partnership with us. That gives the credential that traditional players in money market are willing and happy to enable this in the digital space and see the value. That's what that was about, and that is what that is about.
So Walter, you had made a comment sort of offhand that Paxos was sort of, I'm going to paraphrase, regulatory forward and always has been. Talk a little bit about that approach, because that was a challenging thing to be when there wasn't clarity in the space. And I think we all probably were wondering, are we going to trip a wire unintentionally here without that clarity? But talk a little bit about the responsibility maybe that Paxos saw it had to always be trying to filter in that regulatory responsibility as you built out the various assets and various capabilities that you had.
Well, we had the vision early on that, we would get to this stage of adoption and, ultimately, far beyond this, which is we have more conviction of today than we've ever had. And that is going to require specialization, and it's going to require specialization at all different levels of the stack, as opposed to if you go back like 10 years ago, what did crypto companies like at that time look like? They were doing everything. We were a custodian, we serve retail, we serve institutional, we have an OTC desk, we have a tokenized this, we have, and that was what the businesses look like. And as the business matures, there is a need for specialization, and we always have been interested in building kind of modern financial market infrastructure. And so to focus on infrastructure, which that, to your point, didn't feel like a very smart thing to be doing back in 15, 16, and 17. And it felt very painful to be doing in 22 and 23. You had to go and be regulated. And so at Paxos, we've always seeked the highest level of regulatory oversight. And then we've actually operated our products out of those regulated entities. And that's important because, especially when you're serving the retail markets, it's very like marketing forward. And so there's a lot of regulatory association still in the crypto ecosystem of people saying, I'm applying for this, charter or this license, or I have this charter and license, but they might not even operate the business through it. We've always operated our businesses through these regulated entities. And that's not just so that we can, boast about it and, or take the different, types of brain damage and scar tissue that comes along with it. It's because that's allowed us to serve enterprises. Yeah. And you look at our customer base today, and just look at the public companies that have chosen us as their infrastructure. It's over $1 trillion of market cap of companies, from MasterCard to PayPal to Nubank to Mercado Libre, Interactive Brokers. And the reason that they can do that and have the trust in Paxos, one of the important dimensions of that is the regulatory oversight that we come with.
So Nathan, you must have a similar take on this, is what I got to imagine, because you're coming at it. It's funny because the panelists up here have all come at this from a different direction. I want to talk to Carlos in a minute about this topic, but do you have anything to add on to what Walter just said about your experience?
Yeah, I think, in many ways, Paxos pioneered the idea of regulatory first. I think you guys were one of the first, if not the first, trust charter within New York. And we very much agreed with that thesis, that the way to build to last within the digital asset ecosystem was to pursue regulatory clarity, even when it was hard, even when it was difficult. Many large institutions said, hey, we want to be second. And there's a really good reason that you want to be second, because the ones that go first get in trouble. They have a lot of problems. They go through the growing pains. You talked earlier about the scars. But I think what we're finding is there are an entire set of institutions that would never have touched crypto with a 10-foot pole. BNY, relatively speaking, had a lot of courage to decide to get into crypto and the crypto businesses when they did. Similarly, BlackRock and a lot of the other institutions. But what we're seeing now is super conservative institutions say, hey, we can no longer wait. We can no longer stand on the sidelines of this. We need to come in. And so what we're finding is that despite the fact that it feels like there's a regulatory lifting, what's happening is there's an even bigger set of institutions that are now coming in that want to work with the most regulated institutions they possibly can. because absent that, they were never going to come in the first place. And it turns out that that is almost like an iceberg in a sense. And the iceberg of conservative institutions that are now coming in, I think is going to be really one of the main stories of the next 24 months.
Wow. I'm going to play that back because not only did he give a time frame, but he said that the most conservative institutions that were previously sidelined from participating in the digital asset and crypto ecosystem are now for the first time ever waking up and saying, hey, like, we're coming in. We're trying to get involved in the digital asset ecosystem now that the regulatory environment's a little bit better. But he specifically mentioned the image of an iceberg, okay? Where, you know, if you're looking at an iceberg, it's just a little tiny. I'm sure you guys have seen that picture floating around somewhere on Twitter. It's just a little tiny picture of an iceberg tip poking out of the water, but then underneath you have the body and the heat of the iceberg sitting underneath of that. And that's what's still about to come on chain. And I just truly think that people are underestimating the long term of this space, like this gentleman said, over the next 24 months, 12 to 24 months, give or take. So still inching us closer towards that 2030 objective. But so many people still thought it was going to be this year. It was never going to be this year. It was going to be more so 2026, 2027, 2028 timeframe. If you have the patience, the longevity in this space, and you've been doing this research, hearing those dates don't really bother you because you've already been in the know, knowing that that's really how long it's going to take. Zooming out, though, and looking back, once we get to 2030, it's not going to feel that long, right? 2 to 3 years from now, 12 to 24 months is not really a long time. That time is going to fly by like that. So I'm going to run that 30-second clip back here where this gentleman from Anchorage Digital goes on to pretty much say that the institutions are here and they're not effing about. This is pretty crazy to hear.
I think that's probably right.
Just put brands, ones that go first get in trouble. They have a lot of problems. They go through the growing pains. You talked earlier about the scars. But I think what we're finding is there are an entire set of institutions that would never have touched crypto with a 10-foot pole. BNY, relatively speaking, had a lot of courage to decide to get into crypto and the crypto businesses when they did. Similarly, BlackRock and a lot of the other institutions. But what we're seeing now is super conservative institutions say, "Hey, we can no longer wait. We can no longer stand on the sidelines of this. We need to come in." And so what we're finding is that despite the fact that it feels like there's a regulatory lifting, what's happening is there's an even bigger set of institutions that are now coming in that want to work with the most regulated institutions that they possibly can. Because absent that, they were never going to come in the first place at all. And it turns out that that is almost like an iceberg in a sense. And the iceberg of conservative institutions that are now coming in, I think is going to be really one of the main stories of the next 24 months.
Yeah, I think that's probably right. I want to go down to Carlos because of all the people. One of the things, I've known Carlos now for
a long time.
Carlos had hair when I met him. So a long time. And I've always been a big fan of securitizing. You've been particularly fearless in the RWA side of things with that lack of clarity. I wonder if you could just share a little bit about what kept you going amidst this lack of certainty and this great opportunity that you saw with RWAs and securitizing. Maybe walk through a little bit what that experience was like for everybody.
Look, we started in tokenization arguably way too early. And if I had to start again, the thing that I would have done is not start at that time and start like 5 years after. Because as you know, when we started, I think everybody had the same vision that, ultimately capital markets is about updating ledgers and moving things in ledgers. And, blockchain is obviously a much superior ledger technology. And there is no question that this will be adopted at some point as the infrastructure of the future. The question has always been, when, not whether it was going to happen. And then we were way too early. And what kept us going was, I think, three things. First, we've always made, incremental progress over the years. So you always see that things were slightly more happening. And then we got a transfer agent license first, and then a broker dealer, and then an ATS, and then all the things like that. And then we started working with, KKR first, and then Hamilton Lane, and then BlackRock. And we've always made progress, and not as much progress as we made in the last 18 months, but, definitely, things were moving alongside. So that's one thing. And the other thing is obviously that we've always had a core group of investors that really believe in the mission of what we were doing and continue supporting us over the years until now we're profitable. So now we don't have that kind of problem, but you have to have the financial support to keep going and building, as Walter and Nathan know, building a regulated entity is much more expensive than playing regulatory arbitrage like some of the people in my space unfortunately do, and then going and issue, unregulated assets offshore just to, bypass regulation. So we've always had the vision that we have to, be regulated. We have to operate out of the US. The US is the largest capital markets and the most sophisticated in the world. And, this is 40% of the entire capital markets, but the other 60% very quickly declines in like quality and attractiveness. So if you want to build a business, it has to be done here, no matter how difficult it is. In my opinion, it's very funny. We have competitors that are building global markets that exclude the US. Well, that's not global by any metric, because if you build a global business, it has to include the US. So anyway, I think that we're in a point where a lot of the uncertainty we had in the past, that, by the way, it was uncertainty, but allow us to operate anyway. It is now gone, and as Nathan was saying, this will allow very large, very conservative.
I think liquidity and other things, but the idea that you can just tokenize any real world asset, it's a really important distinction. Like, liquidity doesn't come just because you've tokenized. You can create an ETF of anything, and it doesn't mean that people are going to buy it or that there'll be liquidity in it. And I think that distinction is really important, and something that I very much appreciate that Carlos and team are very focused on. Because again, as a system here, what's important is that we all sort of work towards that system. It's the flywheel of the system that will enable blockchain, digital, and stable coins and all these other pieces to actually fit together to have a faster capital markets and enable the access and democratization of those real world assets and funds that are out there in the tokenized space.
So we have about a minute left, so I'm going to go pick on you, Nathan, for this one.
Sure.
If we were having a beer, just the two of us chatting, what's the one thing if you were going to share with everyone that if you could have done it differently, you would have?
Oh, this is hilarious. I wouldn't have. This is it's way too hard.
You wouldn't have done it at all.
Yeah, it's I mean,
that's awesome.
I was doing a investor reference check on these two founders that are looking to start a digital asset bank, and what I told the investors, like, listen, I think these guys are just naive enough that they might actually pull it off. Because if you actually knew how hard it was, you actually knew like how difficult it is to go through the process, particularly of becoming the first one to be regulated in a certain area. It's just very, very difficult. There's probably better ways to spend your life. So I think if we were a few drinks in, that's probably what I'd do.
That's great. All right, we'll have to see what else we get. Anyway, thank you all to the panelists. Thank you all for being here. Thank you, Salt, for having us.
No.
I like that in the comments, Cyril. I wouldn't have. Yeah, I agree. So really great. Only two key takeaways from that panel discussion. Number one, TradFi and DeFi will merge. He pretty much said that, DeFi will become TradFi, TradFi will become DeFi. That right now the two are separate, and then in the near future, we're going to see the merging of both really start to take place. The second primary takeaway from that panel was how he mentioned just then at the end that we are seeing for the first time ever in history institutions that were previously sidelined for the first time ever really come on board. They're saying now that we can't wait. Huge undertone shift from what previously existed in this space. And so, let's just go out right and say that out of the 70 to 80% of institutions that are still sidelined in this ecosystem, not participating, let's just imagine if they allocate 1 to 2% of their assets under management into the crypto ecosystem. We're looking at a $10 trillion plus market sitting right now at $3.7 trillion. So the opportunity over the coming months, 6 to 8 to 24 months, huge potential. Just paying attention to detail and being on the right side of history is extremely important at this point in time. I have time for maybe one more panel discussion. I kind of want to listen to, okay, great. So that's the next one. We got Chair Atkins sitting here, the SEC chair. That's really the panel that I wanted to tap in and listen to. So we're going to lock in. We're going to listen to this one. If Aqua does tap in on this panel, then we'll stick around for maybe one or two more. I don't think that he is going to be tapping with us today, which is great. It's all good. Hopefully you guys have enjoyed this. We've gotten to about 2 hours of this Wyoming Blockchain Symposium, day one. Live day two is actually streaming on the SALT YouTube right now. So maybe when you guys get done this, you all can always go over to the YouTube channel yourself and watch these panel discussions. If you guys ever want to know where to find these hidden panel discussions, you all can always tap in with us in the private CyberX Discord, where the researchers from all over the globe are always constantly dropping non-mainstream, non-biased, and non-opinionated research in our private Discord. I'm literally talking about hundreds of documents. I actually hand stamp and say this with confidence that our Discord probably has the most fundamentals on the face of the internet, right? I'm talking about PDFs that you will never come across on the internet just doing a simple Google search from the largest organizations in the game, the biggest three-letter agencies, the systemically important banks and people that actually matter in this space. Panel discussions that you will never find because they're private videos and you can't find them on YouTube without actually having the link and having LinkedIn connections like some of our researchers do. So come check that out. Try it out for a month. Lock in with us in the CyberX Discord. If you don't like it, then guess what? You can cancel your subscription, but I guarantee that you will. I guarantee that you'll learn something and that you'll take something away from our Discord just being in it for 1 month, right? So go give it a try. Head over to cyberxtrading.com. We'd love to have you on the team. Let's continue to listen here on the panel. Next, we have Chair Atkins giving us his insights, hopefully, into the digital asset ecosystem and the regulatory clarity that's coming in this space.
Oh, you really can't see anything. Somebody can announce us? No? Okay, hi everybody. Fireside chat we have with SEC Chairman Paul Atkins. So much to cover. It's going to be hard to cover it in a short period of time, but we'll see what we can do. I know he doesn't need an introduction, so welcome back, Mr. Chairman. This is your third act here at the SEC, and we were so thrilled to have you back, much more so than the third act of your predecessor. You know, I think the first act from him was enough, but we are so delighted to have yours here. Thanks. And so it's a new day at the SEC, and you've been saying that, and I just want everybody to be able to hear from you about what that means to you.
Well, it is a new day, and especially for this industry. I've been in and around it for a while, obviously, and so I feel your pain, and just even hear some of the stories I've heard about debanking and other sorts of things. The lawfare that was being waged over the last few years is even more than I imagined. And so I think obviously we've changed as far as our approach goes. We're no longer head in the sand, which has prevailed for a while. Hoping maybe that crypto would go away. And then after that came the regulation through enforcement. And so we saw how that went. So now it's different. Now we're about innovation. We want to embrace innovation. And historically, the SEC, frankly, has not shunned innovation. It might not have been at the vanguard of, kind of being the cheerleader for it, but it didn't stop it. And so going all the way back to like the 1960s, there was a big bull market there in the United States equities markets. And so there was so much trading, and they were dealing with paper certificates, which are pretty cool when you look at them, works of art, they're nice for the wall. But the trouble was that, you had to process them, and there was not the data processing ability and capability at the time. So the New York Stock Exchange and other exchanges had to close down at least one way. So the SEC was there and worked with the industry, and that's how DTCC came about, where securities were then digitized, and so they were globalized, the globalized securities and immobilized that way, and then traded digitally. So that was a huge innovation. And other things through the years, the automatic trading systems, ETFs, all of those things SEC enabled through a creative use of rulemaking, of course, prompted by people, approaching the SEC and saying, what if, can we do it? And I remember my old boss, Richard Breeden, in the early 90s, the staff had been trying to think about ETFs. And when he said, well, because he had dumped the whole big file on my desk saying, figure out why this has taken, years to not even get out of the agency. And so the staff was saying, well, we're not sure if the market wants it. And so Richard had the best retort, well, how do you think you're going to find out? And that is like, let's try it and see what happens. So that things like that is what we're doing now with Project Crypto, and working with our counterparts at other financial regulatory agencies through the President's Working Groups. So we're still meeting every week. We came out with a report a few weeks ago, which I encourage you all to read. It's relatively thick, but anyway, but it's, I think there are a lot of great ideas, and we're setting out at the SEC to implement them as soon as we can.
Yeah, it is a new day, right? And you guys have already made so much progress, Commissioner Peirce with the task force. And, one thing I think people don't understand is how OG you are, and that, back, he really is. And so like in 2015, I started in this in 2015, and I think you were in even before me. So he is very OG in the crypto space. And the traditional finance space too, which is so important to have both the TradFi, expertise and knowing the history and from you were a kid, going through computers and stuff, like first mover, always trying the first electronic products and everything this whole time. So I think it's, you can really see that in your leadership. And I don't know if everybody knows these things about, how, how tech forward you've been throughout your entire life and career.
Well, I still have an analog watch, but anyway, but that's okay. But no, there are, there's a lot to be done. There's a lot of spring cleaning to do at the SEC, not just with forging new roads, with this industry, but on the traditional side, there's a lot of, like I said, spring cleaning to do. When we look at, say, the IPO markets, I've said before, I want to make IPOs great again. There's so much negativity around going to the public markets right now because of a lot of things, just the cost of it, the complexity of the regulatory scheme and disclosure, the litigation issues around corporate governance and the weaponization of some of that. So we need to clean up a lot of that and make it much more efficient. And so we'll be setting out to do that and bring people on to help us achieve that.
Yeah, and with the launch of Project Crypto, I think that's a really great initiative and moving forward and doing all of these things. And I think, I was very thrilled to be in the room when you announced it in that speech. And I think there was a standing ovation around the world about, bringing our markets on chain. And can you help everybody kind of understand a little bit more about Project Crypto? Because there's so many really important parts of it that you've discussed about, is bringing it on chain and making the US the crypto capital, and, reshoring crypto offerings, and how important just competition is, how important, choice for market participants, and even regulatory competition. So
yeah, there's a huge amount to do. And so the good thing is, we have a president who has thrown down the gauntlet. I mean, he's not shrinking from this, and he understands the importance of it. He said it many times himself, even before he got into office here most recently. So, he wants to make America, the world running on American technology, and make America, the crypto capital of the world. So that's a pretty, that's a pretty good goal, I think, and a challenging one. So we at the SEC, in our little patch, it's an important patch of it, need to be forward thinking. And again, with this President's Working Group and David Sachs and Bo Hines, who are leading that, I think that's been in Treasury that has taken the pen to it. I think that's great. Has written down a whole, we've forged a whole bunch of to-dos from that. And so we'll be, attacking that, and already are. So as we go on, there are a lot of questions to be answered. And so I'm, salute the work of the folks in Congress who have, passed the Genius Act, which was great. Hallelujah. I mean, that really is a seminal step for the United States Congress and the government to now officially recognize at least one part. And so then there's a second bill that's come out of the House of Representatives called the Clarity Act. And you heard from Chairman Scott here earlier. He's a great guy. He has a really great committee that he's working with, the banking committee. And so I look for good things to come out of that. There's some things that we need to do in this whole thing, but part of it is to bring clarity to this industry. You've needed it so badly. You've paid enough in legal fees and whatnot, not just to fend off the government, but to try to figure out, what the crazy quilt of different opinions, court opinions and statutes in the different jurisdictions. How do you kind of push forward in a legal business? And so that's one thing that we want to try to do. But what I really hope for is, I didn't come to Washington to engage in the turf battle. That's the last thing in the world I want to do. But we have to future-proof what is going on and what we're going to be doing, the rules of the road, because 5-10 years from now, things will be completely different, I'm sure. And we can't put things into little, cement surrounded pockets that are immutable. So we have to have flexibility, I think. And so as far as the different areas, so securities, commodities, the banking area and whatnot, stablecoins, with the Genius Act, I think that took a really good stride there. And so for the rest of it, I've been talking about having a super app type of approach where why does one have to have a type of permission slip to go from being a broker dealer to dealing in commodities or whatnot? I think if we have, if you look at the banking industry, where you would never really design the regulatory scheme for 150 years, but it works. It's very flexible. You have, the banking system, and you have the different pockets of it, the Fed, the controller of the currency, the FDIC, and all that, and the states. So, but if one regulator becomes too obstinate or something like that, you can take your charter and go somewhere else who might be allowing you to do what you might want to do. Like, for example, famously, life insurance with banks. The control of the currency back at, maybe 40 years ago, allowed banks, national banks, to go into that, and then others followed suit. And I'm not talking about going down to the least common denominator. I'm talking about having a system where there is, we keep people honest by having kind of friendly competition, friendly, balance of power, and without having, I like to compare to, the 1500s, the Pope divided the world between Spain and Portugal, the two big empires trying to struggle over Terra box back in the 80s. In the 90s, I'm thinking of single stock futures, portfolio margining. It wasn't that the two commissions didn't get along, at the board level, but it was even at the staff level where there was sniping and just prevarication there that didn't allow things to move forward. So anyway, so all I'm pleading for is, flexibility so that we can keep the regulatory scheme adaptable to changes in the marketplace and technology as we go forward.
And I think that's a really important distinction too, and like the Shad-Johnson Accord of making them work together to come up with something. And I think it's novel the way that you're thinking about it more as of an alternative, right? So they have the alternative types of frameworks. So there's one under different regulators, and there can be federal and state. And so there's optionality depending on your business, depending on how the regulators choose to do their regulations. So like some of the things I think people don't recognize is all of the authority, exemptive authority, and how flexible the SEC is as an agency compared to the other agencies. You can trade on smaller systems. You have the Reg ATS, alternative trading systems, and you can exempt out and do so many flexible things with the SEC using the exemptive authority as long as it's not hamstrung, by any kind of legislation. So I think that's really novel and something that people, maybe aren't appreciating the ability to have alternative systems in a super app. I love a horizontal super app where you can, trade your commodity securities and other things on one platform,
right. There's no reason why not. And so we have, right now people don't realize it, but securities exchanges could, if they wanted to, trade gold or, wheat for that matter, not the future side. That has to go to under this Commodity Exchange Act to futures exchange, and there they have their regulatory what we do with a statute. So again, to future-proof it from hanky-panky in the future, from somebody coming again. But anyway, but we have the flexibility to move forward, and we are moving forward, able to follow on with the path that we have set forth.
Yeah, and with that too, the work that you're doing with the administration and Congress, I think is also important, and people want to know about. Is it was in the the president's the working group paper that about continuing forward with what you're doing, and you've been working on a lot of kind of things that are really integral to market structure. Yes. And so to see kind of your approach, how the SEC is approaching market structure, which may be different than what we're seeing in the current drafts of the legislation. And one thing I wanted to focus on particularly, because there's a lot of chatter about it in the community, is this focus on decentralization in the legislation, and just kind of get some of your thoughts on that.
Yeah, that's a really good point. So decentralization, I think, is sort of a red herring, frankly. And it's nowhere in the statute, and it's not in Howey, it's not in, so anyway, it's kind of cropped up, and the SEC at the staff level made a kind of a statement about that. So a number of years ago. We're not, I don't personally actually, feel bound to that at all. We're going to be going in a different direction. And again, this is with the flexibility. I think we should have learned over the last decade or so that, we cannot have things so abstruse that, lawyers can't give opinions to their clients, and that the clients then have to spend lots of time for legal analysis that may not go anywhere. So that's our goal, is to have good rules of the road that we put down, and hopefully, again, like I said, undergirded by statutory explicit statute. But in the meantime, through our own work with exemptive authority and other things, we'll be able to provide that certainty. So, as far as the decentralization issue goes, again, I think that's the wrong analysis, with respect to the securities laws.
Yeah, and I think it's kind of interesting that such a focus on that. I'm not really sure, where it came from in, continuing to grow any kind of support, because even, people, I think, that came from a former director of corporation finance statement that, many securities lawyers and others have just kind of disavowed and not thought that was the right kind of way forward, overly focusing on one factor of a multi-factor test of one type of a security to then somehow take over the entire analysis of securities law.
Could be put on chain and make it much more efficient to process them and everything. So he did, and he had a company that was doing that. But so that wasn't a security. This on chain and all that, very centralized. That's not a security. And so I think the analysis has to be different. If you look at Howey itself, the orange itself was not a security. The orange tree was not a security, but the gestalt around it of, the organization and the promises made and all that, according to the Supreme Court, that was a security, but the individual components are not. And so we cannot go about looking at oranges, the tokens themselves, as necessarily being a security. I know there's a difference in the circuits, and we've seen with respect to some of at the district court level on the federal side, some of this analysis, maybe different ways. But I thought that from the SEC's perspective, we will plow forward and on this idea that just the token itself is not necessarily the security, and probably not. There are very few, in my mind, tokens that are securities, but it depends on what's the package around it and how that's being sold. But I can buy an orange, and I'm not necessarily buying the promise to have somebody harvest it, squeeze it, and then market it and then send me the dividend. So that's a lot different than I think just buying a token, in the marketplace. So anyway, that's how we're going to be proceeding, and obviously there will be nuances and whatnot. But our goal is to set, really firm and helpful guidelines that can be changed later. So let's not have it etched in stone through statute and whatnot, but we can be flexible, as the technology develops. So I think it's a really exciting a time to be involved in all this, and look forward to comments and from you all and your colleagues. So.
And Congress and the administration are lucky to have an SME like you to go to. We're very fortunate, and so glad that you're leading this, and you're making it so that not only we have some clarity and forward-thinking innovation, but also being, I think how you said it is perfect, is then when you are a security, it's not a scarlet letter.
It's not.
So.
Right.
Super weird. I don't understand why this live stream was skipping like that, because it wasn't me skipping it, but is what it is. All right, so that's it for today's live stream. We did about 2 hours today, so hopefully you guys enjoyed some of the panelists that we had on stage. If we have time tomorrow, we'll come back. We'll do another live stream before our Friday Wealth 28 podcast, so make sure that you guys tune in with us for that. If you guys enjoyed, if you're watching this as a recording, smash that thumbs up button and subscribe. We do appreciate the love and the support. Thank you all so much for tuning in with us live throughout the week. We're going to constantly stream these panel discussions. However, right now in my tab of panel discussions that I have for you guys down the pipeline, I literally have over like 20 tabs open. If you guys ever want to avoid waiting for us to stream these panel discussions for you guys, and you want to find these panels from these systemically important organizations, these three-letter agencies, these people that are actually building and developing in this space, head over to cyberxtrading.com, tap into our CyberX Discord, where we have the biggest storehouse of knowledge and wealth of information in the private CyberX Discord that never reaches the mainstream. Documents, panel discussions, insights from industry-leading experts that, again, never reach Twitter, never reach YouTube, because they're coming from organizations that don't really have a large influence or following for them to be spread out. So come tap in with us. We'd love to have you on the team. Try out the Discord for a month. If not, you don't like it, you can always cancel your subscription. Maybe we'll see you on the inside. And if not, make sure that you guys are at least subscribed to the YouTube. Make sure that you guys are following us on Twitter. We do appreciate the love and the support. With that being said, many blessings to you guys, and I will see you guys in the next live stream. Everybody take it easy and have a good rest of your week.